Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, May 21st, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. Not really much going on right now in terms of economic reports. Yesterday was quiet. Today's quiet. Things will start to pick up a little bit later in the week. Really, the one thing I'll be looking for is the initial jobless claims. Last couple of weeks, 2 weeks ago, we had a big 10% jump in the initial jobless claims, up above 230,000. Last week, I think we settled back down closer to 220,000, but still both of those readings were higher than what we've seen of late. Of course, this comes on the heels of the jobs report being less than expected, retail sales coming in lower than expected. Consumer confidence has been kind of moving a little bit back to the downside. So we've had some, we have some things that maybe are starting to look a little bit more worrisome from an economic perspective. I don't think they're horrible, but maybe some little cracks in the foundation, which I'm sure the Fed is paying attention to. And we also just had the CPI report come out along with the PPI report. And of course, those came in. The PPI was a little bit hotter than expected. CPI, though, came in below expectations. And I think that cooled a lot of the inflation fears that were out there. At least the market reacted like that was the case. And through all of this, we've seen the S&P 500 and most of the major indices move back to all-time highs. So again, the stock market looks ahead. The stock market doesn't look at necessarily what's going on with the economy right now or what's going on with inflation right now, or maybe even the past couple of months. The stock market's looking ahead, and it's trying to determine, number one, what's the Fed's next move? Are rates going up or are rates coming down? I think for the most part, I think the market has been believing rates are coming down. But the question has been when? When do they start? How deep do the cuts go? How many rate cuts? All of those are still up in the air. Everyone's debating that. And so as that debate kind of, ebbs and flows back and forth, that has been dictating some of the short-term stock market action that we've seen. Personally, I believe we do the show. You probably come here because you want my opinion. My opinion is that rates are going to go down this year. Fed funds rate will decline in 2024. I think the big question is how many times. I'm going to go with 2. I think that there will probably be one in September. My question is whether, and maybe we'll see what happens here over the next couple of weeks, but question is whether or not we get a surprise cut in June. And I don't know. I've seen enough economic reports coming in where the Fed isn't going to want to sit too long if they don't have to, in my opinion. But we'll see. We'll see how it goes. I think there's this outside chance there's still a cut in June, but I think probably at the latest, I think the first cut comes in September. Let's see. What else do we have out there today? I'm trying to think if there were any other stories. I have had a lot of questions come in. Another one in particular this morning asking about the performance of the defensive groups outperforming the S&P 500 of late. The fact that gold and silver have been outperforming the S&P 500. And essentially, what does that mean in terms of market guidance? These were some of the things I pointed out, especially those defensive groups and how the consumer stocks relate to one another, staples versus discretionary. Many of these things that I talked about back at the end of 2021 are resurfacing. So the obvious questions are, okay, well, when you saw it in 2021, you called for a bear market ahead, or at least the potential for a bear market going into 2022. Why am I not on that same page right now? So I'm going to spend some time talking about that. Hopefully put those questions to rest, at least for now. We'll see what happens the rest of the year. I might be readdressing them later, and maybe things happen and they become more of an issue. I don't believe that they are an issue right now, and I'll explain why later. But anyway, Have gotten questions in, and specifically another one today. I've addressed this actually 2 or 3 times over the past month, maybe. But I know, I'm talking, and, I've got a daily market report. I've got articles and stock charts. We've got these shows. I now do a weekly recap on the weekends. So I know it's not easy for everybody to see every show and every article and every report that I send out. So I'm going to go over it today and then have the video available for any more questions that come in. Hopefully we can just send a portion of this video out and everyone can check it out. But anyway, we're going to get to that later in the show. For now, what I want to do is take a look at what happened yesterday. So taking a look at the Dow Jones, we did see a little bit of weakness on the Dow later in the day, with the Dow finishing down 197 points. A lot of that was JP Morgan. JP Morgan yesterday, there were some discussions with Jamie Dimon, the CEO there, about stepping down. He's always talked about his 5-year plan, and he now has said, well, it's less than 5 years. It's not going to be 5 years. That spooked JP Morgan. I mean, if you look at yesterday's chart on JP Morgan, it literally was like a big slide, just straight down from about 204 to maybe 195, like $9, close to 5% of the stock chopped off because of that announcement. Personally, I think that is way, way overdone. Obviously Jamie Dimon's done a great job over a long period of time, but I think putting that kind of knee-jerk reaction on that, first of all, we don't know how long he's going to go. He's probably still going to be around 3 or 4 years. We don't know. They haven't necessarily talked about who's going to be the next choice for CEO there. I think there's a lot that we have to go through. So personally, I thought it was kind of a big knee-jerk reaction. The banks are really strong right now. I think it's an opportunity short-term to get into JP Morgan. That's personally, I actually did that, started getting into it late yesterday afternoon. And if it keeps going down, I'll buy more. I think that was again, like I said, a knee-jerk reaction for something that we don't even know when it's going to happen. And we knew it was going to happen. He's not going to be there forever. So anyway, that was one of the big reasons why we saw the Dow underperform. The S&P 500 actually rose, but just a fraction, up 0.09%, so just below 0.1%. But it is still above that 5,300 level, closing at 5,308. The Nasdaq 100 jumped 128 points, up 0.7%. We saw some of those semiconductors moving again yesterday, along with NVIDIA. NVIDIA will be reporting its next quarterly earnings after the bell on Wednesday. So you've got just another day or so to prepare. That's going to be a big, big report. Actually, let me just make sure. I believe that is Wednesday. It's Wednesday or Thursday. Yeah, it is Wednesday. So they'll be reporting after the bell. The estimate is for $5.49. Personally, I think they're going to blow that number away. The only question is whether or not the market's already priced it in. So we'll see. But my prediction is that you're going to get another blowout report from NVIDIA. Mid-caps gained kind of like the S&P 500, about 0.1%. Small caps gaining 0.2%. Really not a whole lot going on there. Transports continue to struggle. Down yesterday, 73 points, which was almost 0.5%. And we did close at 15,428, which was back below the 20-day EMA at 15,445. Just barely. But I really think this is the level where we need to see the transports turn for their benefit. I'm not saying the stock market can't go up without the transports. Market's been doing it, setting new highs. But it would be a whole lot easier and probably a whole lot more settling for a lot of investors to see transports start to perform better than they have. Technology leading yesterday. Look at the 3 groups leading: technology, communication services, and industrials. These are 3 aggressive groups, 3 of the 5 aggressive groups that we like to follow, along with discretionary, which has been horrible of late. Again, I'm going to talk about that later in the show. And financials. Financials have been very strong. Didn't make the top 3 yesterday. It's all right. Let's give them a break. Part of that, again, relates back to what happened with JP Morgan. Recreational services, the best performing industry group, gaining more than 4.25%. If you looked at those cruise lines yesterday, Norwegian, Royal, and so forth, really good action there. You can see a huge move back to the upside threatening a breakout. Probably the only thing bearish that I see on this chart is the fact that the AD line is just not responding. Yesterday, big volume, finished close to the high, and as a result, we got a little bit of a pop, but we got a long way to go. Let me zero in. You probably can't see that very well, but look at this right here. Just barely started to turn up, but through the last big uptrend, through the downtrend, and now on this uptrend, you can see the AD line just continues to move lower and lower. That doesn't always mean bad things, but it's just something that puts a question mark in my head. If you've got prices that are breaking out and the volume's heavy and you're showing relative strength, I can somewhat overlook a weak AD. But we haven't broken out yet. We've been sideways consolidating, and it's not like this has been one of the strongest groups in the stock market. So the relative strength isn't really there. So the AD line to me just kind of adds to those question marks. So yes, it was a good day yesterday. Yes, it's been a good May so far for this recreational services group, but I don't know that I'm yet ready to buy in 100% into the group. Aluminum continues to strengthen. We've seen this strength off of the February low, continues to push higher. AD line in this case is turning up. We haven't broken out, but we are turning higher, which is a good sign. I think short-term aluminum continues to be a very strong area that you can trade. If we lose the 20-day moving average, we'll reevaluate. Semiconductors also strong yesterday, gaining more than 2.25%. This was one of the big reasons why we saw technology leading yesterday. Nice move off the low that we saw back in April. Had that correction. We didn't go down. Actually, I guess we did go down more than 10%. So for semiconductors, we did have a correction, and actually pretty darn close to a bear market, 20%. We got up, I don't know what that high was, probably around 16.6, 16.7, and dropped back down to 13.5. That's 31. That's just under 20%. I didn't even realize it had dropped that far. But let's keep in mind how far semiconductors went up before the decline. If you're getting into a volatile group, it's not just volatile on the upside, it's volatile on the downside as well. But the group has bounced back. It's almost ready to make a breakout right with the report of NVIDIA coming out tomorrow after the close. So this is going to be an interesting group to watch. I think Wall Street continues to paint NVIDIA as a leading stock within this group. And as a result, when you've got a leading stock in one of the leading industry groups, you really want to see a good report. Doesn't necessarily have to be a great reaction. We could go down after the report. I mean, we haven't broken out yet. That would just be more sideways consolidation. We've basically put in like equal highs almost. And so if we go up today and, equal that high, and then the report comes out and we drop, even if the semiconductor group were to drop as much as, 1,000 points, it's very possible that what we do is consolidate in an ascending triangle, equal highs, rising lows. So you have to have perspective going into a big report like this and realize that these are stocks that have already made a big move. I think we're probably going to get a breakout because I believe the market's going to go higher from here, at least in the short term. But if we don't, it's not really that big a deal until other deteriorating factors come into play. One thing I will say about the AD line here, we went back up and set a new high in the AD line this past week, even before we made a breakout. So I don't see any deterioration as far as accumulation goes. I think that this group continues to be accumulated, and that too, I think, bodes pretty well for the group in the short term. Moving on, 10-year Treasury yield. So no economic reports out this morning. I'll give you a quick update here. We are down about 3 basis points now on the 10-year Treasury yield. So back down to 4.41%. We had fallen all the way from 4.75 or so back down to 4.34, maybe 4.33. As we were rising, what I'm watching is the moving averages, because if you look, when we first went down below the 20, let me really get this in close so you can see this. But when we first went down below the 20-day moving average on the 10-year Treasury yield, look at what happened when we bounced and hit the 20. We failed. We went down to a newer low, back below the 50. Now we're coming up to both moving averages, and it looks like we're starting to roll over again. This looks more and more like a downtrend. This is how downtrends operate. So until we get back through the moving averages and through this reaction high, which is probably at about 452, 453, I think that is the level that I would watch back to the upside. If we break through that, then I think we've still got issues to go with the 10-year Treasury yield and that impact on the stock market, which has been felt the greatest, quite honestly, in the small cap area. So if we turn back up, clear those moving averages, get back up above 452, 453, it's probably not going to bode well for the small caps in particular, but probably not going to be good overall for U.S. stocks. In the short term, not talking about making a bear market call. I'm not calling that at all. Just want to make sure. A lot of folks will take something I say and kind of build it up a little bit bigger than it is and run with it. I'm not saying that at all. I believe we're in a secular bull market, and I believe we're going to end 2024 at or near an all-time high. Talked about that back at the beginning of the year during the Market Vision event, where I give you my prediction for the entire year. Nothing really has changed. The only thing that I've missed on at this point so far this year is that I was calling for March weakness and it happened in April. Other than that, market's doing pretty much what I thought. I didn't think it's going to be a huge year. I'm not looking for 25, 30, 40% this year, but it's going to be an up year in my opinion. I think 2025 might be even better. But let's concentrate on where we are right now. For now, what I'm looking at here is just the 10-year Treasury yield. Does it get back through those key levels I just discussed, or does it roll back over? If it rolls back over, I suspect we're going to get a breakout in the small cap IWM sooner rather than later. But well, that remains to be seen. Haven't seen that yet. S&P 500. Let's go through these charts fairly quickly. S&P uptrend. We pulled back. We had a negative divergence there on the daily. We pulled back. We reset. PPO actually went into negative territory. We came back up, and now we're moving higher with a PPO that is climbing. That is a good sign. What happened back in November when you had negative PPO and you broke above and you started to climb? Look how long this rally went on for. I'll be honest, I don't see that long of a rally or that steep of a rally coming, but I do think we go higher. Maybe I could even go a little heavier than maybe, probably we see a pullback in mid to late summer. That's what I'm looking for. I think it's typical for a presidential election year cycle. It's also typical just for every year. July to September, always the worst time of the year for the stock market. Well, not always, not every year. Don't take that literally. But if you go back since 1950, it has a clear tendency to underperform. So mid-July, late September is when you want to be careful anyway, but tends to be even weaker during these presidential election year cycles. So that's what I see coming down the road. Obviously, we'll adjust that as we go along if we need to. NDX, Nasdaq 100, same thing. Negative divergence, moving up, pulling back, and now strengthening, moving back through. I think NVIDIA probably holds the short-term key to this Nasdaq 100 because it's littered with semiconductor stocks, and NVIDIA is the leader. So depending on what NVIDIA does, how it reports, how the market responds, probably going to mean a great deal to the Nasdaq 100. If for whatever reason we do pull back after NVIDIA, watch the rising 20-day moving average. That is about 600 points below where we are right now. Probably about 500. 20 days, 18,141. Yeah, about 500 points below. So, and anyway, that's the NDX. Already breaking out. I think the NDX looks great. Like I said, NVIDIA could really add fuel to the fire if we get a positive reaction. Small caps, not quite following suit. It's been a nice run off of the April low. Not going to say anything negative about that. I mean, we moved from 192. We went up to hit 210. Got to close above that 210.77 level. That's the key breakout. We are about 1% below that right now. But if we turn back lower in the 10-year Treasury yield, I think that might be what we need to generate that breakout on the IWM. For the IWM, once you get through and close above 211, there's not a lot out there until you get to the mid 230s. So it could be a very, very nice rally on small caps if we can make that confirmed breakout. And when I say confirmed, I mean I'd like to see volume pick up on that as well. I want to see a lot of folks moving in. Transports, don't really have a whole lot more to say than I said earlier. Very disappointing. This is one area of the market, even though, the Nasdaq set a new high, the S&P up there near a new high. We've had the Dow roll over, but we just hit 40,000 for the first time at the close last Friday. So, I mean, we got a lot of positive things going. Transports ain't one of them. We'll just have to watch it, see if it breaks down again. Obviously, this is a key area. I mean, everyone probably has heard of the Dow theory, or most everyone. And what the Dow theory is that you want to see the Dow transports support the Dow Industrials. The Dow Industrials broke out to an all-time high. Look at where we are on the transports right now, and look where we were back in end of July last year before the correction. That was up over 16,600. We're now at 15,400. We need probably about an 8% move in transports to get back to that high that we saw in July of last year. So a lot of work still needs to be done here. Not a whole lot more needs to be said. I've been harping on this group, talking about the fact that this is one of the negatives in the market. I've been giving you lots of positives, lots of reasons why I think the market's going up. This is a clear negative. It has been down hasn't been down at the close every day this week, but it has a filled candle, meaning that it is closed below the open every single day for the last 5 days. Just not a good look. Moving on, chart of the day. But first, I'll take you over to my house at EarningsBeats.com. Everybody's welcome. It is our spring special. If you'd like to join, what I would suggest is taking out a 30-day trial first. It's free. There's nothing, no strings attached. You do have to provide credit card so we can get you set up in our system. But we will remind you when your 30 days expires. We are not just going to wait and charge you the monthly amount when it expires. We're going to let you know. We want you to be a member if you want to be a member. I think you want to be a member based on all the calls we've made over the last several years. We got a lot of very happy members. But anyway, check that out, because if you do like our service, then you're going to want to click on this link. Actually, you're going to want to click on the link anyway. Scroll down, gives you everything that we offer. But here is the special. This is, and as our members will tell you, this is the best deal that we offer all year long. This is the time right now. If you've been wondering, where's the market going? What do I need to, what's Tom thinking? You're going to want to think about signing up. 1 year, if you extend for 1 year, which would be added on after your trial period. So even if you get 10 days into your trial period and we're getting ready to close out the spring special, you can take on the spring special and get the rest of your 30 days. This would just be added on to the end of it. But anyway, 1 year gets you 14 months. 2 years, by 2 years, you get 30 months, 6 free months. And if you want to go out 3 years, which we have a lot of members that do go out to 3 years. If you've been with us for 3 years, you probably want to be on for 3 more. But anyway, if you do the 3 years, we'll give you another 12 months, another full year for free. The deal won't get better than this at any point during the year. So please check this out. And if you've been on that, wondering, why not at least kick the tires for 30 days? We'd love to have you. Anyhow, chart of the day. So what I thought I would do here is I wanted to bring up the XLC. And the reason I wanted to bring up the XLC is you can see, first of all, we're coming right up here to this prior high around $83. So it's kind of a critical area for the XLC. I mean, this was one of the leaders yesterday, but we haven't quite made that breakout. And if we go to a 5-year weekly chart, look where we were back in 2021, right at about 83, 84. That's where we were at the beginning of April, and that's where we are right now. So we now have a triple top at around that 83 level. If the market goes higher from here, and trust me, there's some stocks within the XLC that could certainly trigger this, one being Google. Google has been very, very strong. I really like Google. at this point. I think it goes higher, and I believe that's going to be one of the key catalysts to take out this high on the XLC and move to all-time highs here. So I just wanted to point out a very, very key resistance level that literally we're sitting right now on the XLC. All right, the last 5 minutes or so, I want to talk about the questions that are coming up about why I believe the market keeps going higher. And the questions pointed out, this will cover most of them, should. The first one is, well, consumer staples have been, performing really well of late. And so, I mean, if we went back, let me go back to the very first screen we had. And I'm going to go over to the sector summary, and we've got periods we can do. So if we go back 1 month, you see consumer staples is about in the middle. If we go back 3 months, consumer staples is, still around the middle, maybe even just slightly below the middle. If we go back 6 months, staples are dropping even further. We go, year to date, staples are still toward the bottom. We go 1 year, staples are at the bottom. So, I mean, first thing I would say is I don't really see a whole lot of outperformance by consumer staples. They have had periods of time, and especially recently, where they have outperformed the XLY. So that part is true. But let me show you the XLP relative to the S&P 500. Now, the first thing I want you to zero in on is look at what happened during the cyclical bear market. Money rotated heavily toward staples. It wasn't just at the beginning, it accelerated to the upside. So if you're kind of looking at staples, the fact that we had a little bit of strength, I mean, we're already rolling back over. I think already I would be not interested in using this as a scenario for a bear market. But we should see money rotating hugely toward the XLP. I don't see it. I mean, this is what's happening since 2023. This is a relative chart of staples versus the S&P 500. They're going straight down. They just literally, in a month ago, set a 10-year relative low. So I'm not seeing the type of strength that we would need to see in staples for me to be calling a potential bear market. That's number one. Number two, the XLY versus the XLP. If you look at this chart, I'm seeing from left to right, I'm going higher. And you might say, well, I mean, if you're looking for the XLY to outperform the XLP every single day, and so that's just a straight line going up, that's not the way it works. You're going to go through periods where, I mean, right now, discretionary is horrible. It's probably been one of the worst areas in the market over the last 6 months to a year, without a doubt. I mean, if I go back over here, 1 year, XLY is in the lower half. But if I go back year to date, I mean, discretionary, the only group it's beating is real estate. So 2024 has not been good to consumer discretionary, but I don't think it's been very good to consumer staples either. And what that tells me is the fact that both consumer areas are not doing very well. And I think that's, part of 2/3 of our GDP is consumer spending, and they're not performing well. So in addition to, the jobs report coming in less than expected, initial jobless claims rising recently, consumer confidence not where it needs to be. It's been actually pulling back some. And what was the fourth one? There was another one. Retail sales. Retail sales coming in below expectations recently. I mean, you've got the signs that the economy is not exactly humming along the way we would like. It's not bad. We still got positive jobs. We still got the unemployment rate under 4%. It's not horrible. It's a pretty good environment, but it just seems to be maybe a little bit of a weakening environment. Whereas if the Fed, keeps the pedal down on rate hikes, or even just puts the brakes on rate cuts too long, I think it could have a bigger negative effect on stocks later down the road. So it's something that we need to keep an eye on. But I'm not seeing the kind of deterioration. I mean, this was the 2020. This was the downtrend with the pandemic where we lost 35%. You can see discretionary versus staples did horribly. How about the cyclical bear market? The top came before it started, and look at the acceleration. I mean, now if we see huge acceleration to the downside, more acceleration, we've seen drops before during uptrends. I mean, there was a drop, what was that, back at the beginning of 2021? I mean, if we had said, hey, it's dropping, we're going to get out, we would have missed another huge run in the second half of 2021. So don't sit on one signal and every time it flips, want to try and call a bear market. That's not the way it works. And I'll show you a couple of other things that were really important back in 2021 that we don't have an issue with right now. But let's move on to utilities, because this is another thing that everyone's talking about. I think the problem is it's recency bias that you start thinking about. Yes, utilities have had a good run to the upside. Doesn't mean we're heading for a bear market. Look at utilities relative to the S&P 500. I mean, for a year and a half, it was straight down, just like the XLP. The XLU relative to the S&P just set a new 10-year low. So to think that I'm going to turn bearish because utilities outperformed for 2 months, 1 month of which I actually called for. Historically, utilities love the month of March. So I was already calling for utilities to do well in March. It's really just been this April-May continuation. But if you keep things in perspective, we've been in a massive downtrend. You could go through any of these other periods. Utilities did well at the end of 2017, but throughout 2018, they got absolutely killed while the market was going up. Then we bounced back during the cyclical bear market in the fourth quarter of 2018. That was the trade war. But utilities actually did okay during 2019, even before the pandemic. The market went higher. So again, individually, these signals don't mean a whole lot. You've got to take these signals in addition to other signals and put them all together. Gold, first of all, I never talk about gold in connection with which way I think the S&P 500 is going to go. I don't look at gold and say, oh, gold's going up, so we're heading for a bear market. The only thing I do with gold is I just compare the two asset classes. S&P 500, would I rather invest in the S&P 500? Would I rather invest in gold? When's a good time to be in gold? That sort of thing. I mean, if you look at gold relative to the S&P 500, this is last 10 years, which side would you rather be on? Would you rather be invested in gold or the S&P 500? Hopefully you say the S&P 500, because the S&P 500 has killed gold, since 10 years ago, since his bull market started, even before the bull market, secular bull market started back in about 2011. It's now been about 13 years. One of the consistent themes with gold underperforming the S&P 500 is the dollar rising. I think the dollar is still in an uptrend. Some might disagree with me. That's fine. We'll see where it goes. But I believe we're going to go back to that 112, 113, 114 level on the dollar. And if that happens, and you might say, well, that's not going to happen if you think rates are going to go down. First of all, I don't know that the 10-year Treasury yield is going to go down a lot. I think Fed funds rate is going to go down. I don't know that the 10-year Treasury yield will go down a whole lot. And that's what's going to uninvert. It's going to flip that inverted yield curve that we've had to endure for quite a while. So anyway, I see the dollar going up. I think that puts more pressure on gold. But the real key, and not too many folks talk about this, if you look at the best moves in gold relative to the S&P 500, all you have to do is look below at the VIX. When the index is spiking or soaring like it did in 2020, that's when you get relative outperformance in gold. That's when you want to hedge. When that VIX goes up above 20, that's when I would consider thinking gold. Not until. I'll just leave this chart here for a second. You can come back and look at it later on the recording. And you can go back and look at every spike in the VIX and take a look at when all the spikes are in gold relative to the S&P 500. It's almost 100% positive correlation. So anyway, that's really what you should be looking at with gold. Again, I don't, the stock market, we could have a bull market or a bear market. Gold could go up or down during either one. It relies a lot on the dollar. It also relies a lot on the spikes in the VIX. All right. This was the biggest reason. If you were at Market Vision 2022, 2 years ago, and you were paying attention, I said that it didn't, that interest rates weren't my biggest concern. Inflation wasn't my biggest concern. The rotation in defensive stocks was not my biggest concern. The negative divergence on the weekly chart, which had been persisting for months, was not my biggest concern. I said going into 2022, my biggest concern was all of the incredible bullishness and complacency among retail traders. We had that huge run on the S&P 500, 115% in 22 months, and everybody was playing calls. Everybody. We had a lot of new traders in the market because of the pandemic. They learned a really valuable lesson, hopefully. Probably their short-term lesson was they never wanted to see the stock market again. But ultimately, hopefully they overcome that fear, because the stock market's the way you generate wealth. One of the ways. Real estate would be another. But these are keys to establishing wealth, is being in the stock market. But you've got to pay attention to these extreme moves in sentiment. I can't overemphasize this. Take a look at every major turn in this 1 year moving average of the equity only put call ratio. That's what this bottom is all about. Down here, this bottom panel, this is a 1 year moving average of the equity only put call ratio. When everybody's jumping in on the call side, the number goes down. When everybody's fearful, panicking, the number goes up. When you reach bottom, well, first of all, when you're coming from a top and moving down, that is when you generally will see the stock market go up. It'll go up as fear is abating. When fear is increasing, the stock market struggles. Here early on, it did okay, but ultimately, until we reached the peak, we didn't see a bottom. Once we got to the peak in 2009, from all the fear, everybody, I remember back then, every one of these bounces, folks wanted to short it. Nope, we got a big problem. The government's stepping in. This isn't right. They had TARP, they had QE, all later on. Didn't matter. We reached a level of fear that was so great, the stock market couldn't go lower anymore. We turned around and began the bull market. Now, we didn't know it was a bull market until we actually got a breakout on the S&P 500 in 2013 above this top in 2007 and a similar top in year 2000. But game on. Once we reached the top in fear and rolled over, look at how much money how far we went up on the S&P 500 in 2 years until we reached a bottom in sentiment. That's when everybody finally said, oh, no, we're not in a bear market anymore. Things are looking great. And so they started trading more and more calls. Then we get to that point, and what happens? We flip back to the other side. And where's the stock market go for the next year and a half? Absolutely nowhere. And while it's going nowhere, the fear ramps up. Then the fear peaks and rolls over. What happens when it rolls over? We break out and we gain 55% within 2 years. Then we go on and then we get too complacent. Now everybody's turning bullish again. We've been going up and up and up for a long time, and now everybody's mentality is changing. Their psychological being is like, wow, this is great. Market's making lots of money. I'm going to jump in. And so once you start getting the masses to jump in, then we see this turn back to the upside. What happens when we're overly complacent and we need to reset the fear back higher? We go nowhere for 2 years. And then we get the breakout. Fear rolls over. And what happens? We make another big run in the S&P 500. Now, I'll say 2018, to 2020 was a rough year because it seemed like there were a lot of head fakes in here. We had the trade war, and then we had the pandemic. We had a good market in between the two. And so this would have been really tough to call. in being honest. If I saw this start to roll over, I mean, I may have questioned it because it was rolling over from a lower level. It really needed to see a little bit more fear come into the market. And we got that with the pandemic. There was the pandemic. We had that last bit of fear. And then what happened when we rolled over? Fear went all the way down to the most optimistic period since we've been tracking the equity only put call ratio. That was the end of 2021. That reading right there in the whole long-term scheme of things just dwarfed all of those prior lows. That tells us, I mean, for a period of time, the equity only put call ratio stayed between about 0.35 and 0.50 for about 3 or 4 months. I mean, it was crazy. That type of complacency, when I saw that rolling over heading into 2022, and if you were at Market Vision 2022, you can vouch for this. That was what drove me to saying, I think we've got the potential for a serious cyclical bear market, not a secular. I thought we needed to reset sentiment, but I didn't think that it would last. At the time, right here, I said I thought we would have 3 to 6 months of weakness. That was my call. We ended up having 9 months of weakness. I thought the market would go down the first half of 2022 and then come up the second half of 2022. Instead, it went down all of 2022 and came back during all of 2023. So the timing of that V bottom was a little off, but the overall call going down into a cyclical bear market and then recovering right back up to all-time highs was spot on. And sentiment was the main driver behind all of that. Now, those other signals, XLP, the XLY-XLP ratio, all the defensive groups leading in December of 2021, we saw some of that now, but we don't see all of it. Again, if I go back right now over the last 3 months, I mean, at the bottom, we've got real estate, we got healthcare, we got consumer staples. If we go even over the last 1 month down at the bottom, we've got our two neutral areas here. We've got staples. I mean, they're definitely outperformed for 3 months. I'm not going to lie, but they don't have all of the other corroborating signals. And if we're going into a bear market, you're going to see earnings per share drop dramatically. And if that drops dramatically, there is no way technology should be leading over the last month. You don't pour your money into technology right before a big drop. You're going to lose a lot of money if you do that. So I don't think Wall Street's sending us the same messages that it sent us back in 2021. Our weekly PPO, our recent highs, excluding the one we just had because we literally have just broken out. We have to see how far we go. But the last two highs on the S&P 500, PPO is straight up. So there's no negative divergence. There's no sentiment problem whatsoever. I mean, in fact, like I said, sentiment, look at what we're doing. We're rolling over. When we see rolling over and moving down, tell me what happens to the S&P 500. Let me know if you see something different than I see. Because I think all of this fear is continuing to unwind. There's still a lot of fear out there. I love all these analysts coming out saying that sentiment's bullish. Fine. If you want to go to some of these surveys where people tell you how they feel or what they're doing, if they're telling you all this, that's great. I want to see what they're doing with their money. I think this is a much better sentiment reading than anything else that comes out. And if you don't believe me, look at this chart and prove me wrong. Tell me why I should be thinking something else. The CPCE, the 1 year moving average to me is going absolutely straight down. Why would I want to get out of this market? Anyhow, I know I went way over, but I wanted to spend some time talking about that because I continue to get questions in. I answer the questions. I get more questions in. I answer the questions. I just wanted to put a definitive end to why I don't see this anything near what I saw back in 2021. Stock market, in my opinion, goes higher. Have a great day, everybody. Happy trading.